Welcome back to Cheryl Trades Leaps. Let me ask you something. Have you ever watched a company report amazing earnings, record profits, massive growth, etc., and then watched the stock drop? You thought, that makes no sense. You're not wrong for thinking that. You were just never learned how the market actually works. Today, I'm going to show you exactly why stocks drop on good news and how to stop being on the wrong side of that trade. The lie we were taught. From the moment most people hear about the stock market, they learn one rule. Good news, stock goes up. Bad news, stock goes down. Sounds logical, sounds obvious, but it's wrong. Or more accurately, it's incomplete. Because the market doesn't just react to news. It reacts to whether the news is better or worse than what was already expected. That one sentence changes everything. Let me show you what I mean. The real example. Let's talk about Apple. Back in 2022, Apple reported quarterly earnings that most companies would dream about. Revenue was up. iPhone sales were strong. Profits were solid. The stock dropped. Why? Because Wall Street analysts had already predicted those numbers, and Apple barely beat them. The news was good, but it wasn't good enough. The expectation was already priced into the stock before the report even came out. When the results matched expectations instead of crushing them, investors who had already bought started selling. And the people who bought on the news, they got stuck holding a falling stock. This happens constantly, with big companies, with small companies, across every sector. And once you understand why, you'll never be surprised by it again. Why this happens, the 4 real reasons. There are 4 reasons a stock drops on good news. Let's go through each one simply. Reason 1. It was already priced in. Imagine a rumor starts spreading that a company is about to land a huge contract. Investors hear about it. They start buying. The stock slowly climbs over the next few weeks. Then the official announcement drops. The contract is real. It's confirmed. Great news. But the stock doesn't move, or it actually falls. Why? Because the price already reflected that news. Everyone who wanted to buy, bought weeks ago. There's nobody left to push the price higher. The news was the finish line, not the starting gun. Reason 2. Expectations were too high. This is the Apple example we just talked about. Even genuinely good results can disappoint the market if they don't beat what analysts and investors were expecting. Think of it like a movie that's been hyped for 2 years. By the time you see it, your expectations are so high that even a great film feels like a letdown. The stock market works the same way. Reason 3. Big investors need to sell. Here's something most beginners don't realize. Large investment funds, the ones managing billions of dollars, can't just sell their shares whenever they want. If they suddenly dump a massive position, the price crashes before they finish selling. So they need buyers in the market. And what creates buyers? Good news. Excitement. Headlines. When a positive earnings report comes out and retail traders rush in, that's the liquidity big funds have been waiting for. They use your buying to exit their position. You buy in, they sell out. Price drops. You're not being personally targeted, it's just how their incentives work. But understanding it protects you. Reason 4. The stock has simply run out of fuel. Sometimes a stock has already climbed 20, 30, 40% in the weeks leading up to an announcement. When the news finally drops, even if it's great, there's just no energy left to push it higher. The move already happened. And at that point, any excuse, even good news, can trigger a wave of selling as people lock in their profits. The trap. Now let's talk about the trap. Because this isn't just about prices and earnings reports, It's about emotion. The market is incredibly good at making you feel things at exactly the wrong moment. When a big headline drops and a stock is spiking, you feel excitement. You feel urgency. You feel like if you don't act right now, you're going to miss out. That feeling has a name: FOMO, fear of missing out. And here's the hard truth. That feeling, that urgent, I need to get in right now feeling, is almost always a signal that you're about to buy at the worst possible time. Because by the time you feel that urgency, the move has already happened. The people who were going to profit already bought. And now they need someone to sell to. That someone, if you're not careful, is you. What to do instead? So what do smart, patient traders do differently? Simple. They don't chase the news. They wait. While everyone else is reacting emotionally, they're watching calmly and asking 3 questions. Is the price holding steady after the initial drop? Is it pulling back to a level where buyers are stepping in? Is there a sign that the selling has slowed down? If the answer to those is yes, then they consider entering. Not during the frenzy, after it. Here's a simple way to think about it. Imagine a ball being thrown hard against a wall. Most people try to catch it while it's flying fast. Patient traders wait for it to bounce, slow down, and settle, then they pick it up. The entry isn't as exciting, but it's far safer. A simple rule to remember: if you take nothing else from this video, take this. Don't buy the headline. Watch the reaction. When big news drops, don't act immediately. Give it a day or two. Watch what the price actually does. If the stock drops on good news, now you know why. It was priced in. Expectations weren't beaten. Big money was selling. And if the stock holds steady or starts recovering after the initial drop, that's often a much better entry point than the moment the news hit. Less emotion. More information. Better trade. How I trade this. For leaps and swing trading, my rule is simple. I don't buy hype. I buy structure. That means I wait for pullbacks, I wait for support, I wait for confirmation, because the real opportunity comes after the emotional move, not during it. So, to wrap it up, the market doesn't reward the fastest trader. It rewards the most patient one. Most retail traders lose money not because they're unintelligent, but because nobody ever explained how the game actually works. Now you know. Good news doesn't mean the stock goes up. It means the question is, was it good enough? And the answer to that was already decided long before you saw the headline. If this helped you, hit subscribe, because this is just one piece of a much bigger picture. See you in the next video.